Okay, PPP Loan Mechanics. This is an illustration of how the Payroll Protection Program loans were applied for by borrowers or applicants, and how the process took place from application through approval by lenders, by the SBA or the Small Business Administration, and how the ultimately the funds got into the PPP borrowers' bank accounts. So this is an eight-step process. The first process in the PPP loan application mechanics is an applicant, or otherwise known as a borrower, approaches a lender, a bank, or another lender, which are generally referred to as SBA approved lenders, or in other words, a bank or some other lender that had been approved by the SBA to make PPP loans. So the first step in the process is it's a business. In this case, we're depicting the business as a restaurant, hence the hamburger and the drink. So the business itself, the business or its entity, if it is owned by a corporation, such as a C corporation, an S corporation, or if the corporation is an LLC, a limited liability company, the corporation is the applicant of the borrower. The corporation applies with a bank or its lender for a PPP loan. It does so by filling out a form depicted here in red that the SBA or the Small Business Generation created during 2020 when the PPP program was created by the CARES Act, the Coronavirus Aid, Recovery, and Economic Security Act, which was created on March 27th of 2020. The CARES Act created the PPP loan program. So the SBA was to administer the PPP loan program, and in doing so, it created these SBA 2483 application forms. So borrower receives the SBA 2483 form electronically from its bank, from the lender. The borrower completes the form electronically in cooperation with its lender, with its bank, and once it does so, it electronically submits the application, including the business's total annual payroll figures for 2019, for calendar 2019. So those supporting documents needed to be submitted electronically to the bank in conjunction with the application. Once that's done, the lender, the SBA approved lender or the bank reviews the completed application, the 2483 application, including the applicant's 2019 payroll documents. The lender is to check the calculation of the PPP loan amount from those payroll documents and confirm that the loan amount is calculated by the borrower correctly. The lender then approves the PPP loan. Uh, Once that's done, once the SBA 2483 form and PPP loan itself are approved, the lender or bank is required to complete an SBA 2484 form for that loan and submit that 2484 form to the SBA. So the SBA approved lender completes an SBA 2484 form and submits the form to the Small Business Administration of the SBA for approval of the PPP loan. So what happens here, the SBA again reviews the 2484 form, approves it. The SBA, or the Small Business Administration, it is an agency of the federal government of the United States. The SBA is an independent agency. It was created in 1953 by the Small Business Act, and it has remained an independent agency of the federal government It's not the federal government itself. It's not the Treasury Department of the federal government. So the SBA works as a branch agency, as an executive branch agency, but it is independent. So what happens here is the 2484 form, once they approve it, this 2484 form, once it is approved by the SBA, does not create the money for the PPP loan. The SBA did not provide the money to borrowers for the PPP loans. Once the SBA 2484 form is approved for the PPP loan, it simply means that the SBA has agreed to insure the bank, not the borrower. The SBA is insuring the bank itself or the lender against losses on that PPP loan. It agrees that if the borrower cannot repay the PPP loan, or if the borrower cannot manage to get the PPP loan forgiven, that the SBA will kick in, the insurance will kick in, and it will pay the bank. The SBA will pay the bank. So once this is approved by the SBA, the 2484 form is electronically submitted back to the lender. The lender now the bank creates another document, a PPP loan note. The note states the amount of the PPP loan that the applicant, the business, is borrowing from the bank. Uh, Once the borrower reviews that note, including the terms of the note, the applicant or owner of the business electronically signs the note. The PPP loan note, once it is signed, becomes what is known as a negotiable instrument. That note becomes a negotiable instrument upon the electronic signature. A negotiable instrument is legally defined as a form of money. Black's Law Dictionary, if you look up the negotiable instrument, a negotiable instrument is a form of money. That signed note, that negotiable instrument, is now money. The bank receives that signed note electronically from the borrower. Now, what happens is the bank has an asset on the left-hand side of the balance sheet. The assets are recorded. So the bank now has this signed PPP note, the loan, as an asset. Let's assume it's for $400,000. The bank now has an asset for $400,000. On the right-hand side of the balance sheets have to balance, so the bank records a liability for $400,000, which it owes to the applicant, the borrower. So through this process here of creating the PPP note, the borrower signing it, making it a negotiable instrument, the bank has received the loan as an asset, and it also has a liability for the same amount for the $400,000. That $400,000, which has just been created through this process, is now transmitted electronically here in step 7 or in step 8 by the bank to it deposits it in the business checking accounts of the company, of the borrower, PPP borrower. This step here, steps 5, 6, 7, are not what we're taught to believe since the time we're young. We initially believe, we believe that banks make loans, and when they make loans with the bank itself, the lender or the bank is loaning us or our business its own money, its own capital, or its own profits. We were taught to believe that that's where the loan money has come from. It's not correct. There's also a theory that when a bank makes a loan, it's loaning out its customers' checking account and saving account money, as well as money that the bank has from customers in CDs or money markets. That is incorrect. The correct mechanics of a loan are that this process of new money creation, the banks create new money into the financial system through loans. that it initiate, and that money is it's new money that's created through the borrower's signature. Um, and now we have new money into the system. So when PPP loans were originated through this process by the banks and the borrowers, through the creation of new notes, negotiable instruments, we simply had new money that was created into the system. PPP money, uh, it didn't come from the SBA. The SBA simply insured the loans against loss for the banks or lenders. Uh, it also did not come from the PPP loan money did not come from taxpayers at all. There was no income tax money sitting around that the government had, that the federal government, the federal government was not sitting on billions of dollars, $800 billion that, that it had sitting around from taxpayer money. Simply, this loan creation process is what created new money into the system. Once that was done, the banks received the business checking accounts received the money. By the way, the entire electronic process, um, whereby the PPP loan notes were created, when the PPP loan notes were created by the banks, an SBA loan number was created. This was done electronically here when the borrower signs the PPP loan note. Banks operated in conjunction, in cooperation with the SBAs through what's called the E-Trans system, standing for Electronic Transmission System. The E-Trans system is where banks communicated with, the SBA and banks communicated through the E-Trans system. And when these PPP loan notes were created, an SBA PPP loan number was created, and that was generated by the bank and submitted to the SBA. That's how a SBA PPP loan number was assigned through the E-Trans system. So these are the correct mechanics of how new money was created into the system by the banks. The SBA simply insured the banks against loss on the loans.